Welcome back to Trade with Conviction, where we deep dive into the world of oil, sometimes avoid the clickbait, and occasionally see our market calls go our way. This week we have Phil and James on the pod with us. Hi guys, how are you?
Good afternoon.
Hi.
Good stuff. And I obviously back hosting again with Rachel, unfortunately not able to make this recording, but the plan is to return to normal service next week. And what an interesting week this week has been, once again, with plenty in the headlines to think about, but also not that much of substance really to be trading on. So, of course, we have all the news on Ukraine. Phil, do you want to kind of start us off and give us a kind of roundup of what has happened, and then we can take it from there?
Sure, sounds like a plan. Unlike the Ukraine peace plan, maybe, as we see that at the moment, no one really knows which plan people are talking about. Is it 28 points? Is it 19 points? Who knows? But a quick kind of status update. Today was supposed to be the deadline. Obviously, that's not happening, it seems. But if we look at kind of what the possible options are from here, we've got still, I suppose, we need to think about the possibility of a deal. And so if does that mean sanctions are lifted then? If so, by who? The US and the EU. If those sanctions are lifted, does that mean more oil into the market, or is it just a similar level of oil and it's redirected? In terms of pricing impact, you would imagine that obviously that should have bearish impact on both crude and products, at least to begin with. Freight, you'd say, should become more efficiently routed, at least, the market, which isn't great for freight ton mileage demand, but who knows what that means in terms of how quickly or if the dark fleet can be reintegrated. So who knows what happens to the supply side. And finally, then obviously on paper, then you get, maybe you'll talk about this anyway in terms of what's been driving Brent spreads. But yeah, you imagine you'd have a bit of a risk off and a selling there. Longer term, I suppose, you on the flip side, if we don't get a deal, then we kind of continue probably down this path, at least for a while, of military, action in continuing, refineries being hit, ports being hit. So I suppose as you can kind of see, there's at least two different paths here, and they're quite contrasting, I suppose, in terms of potential outcomes. And I think you were going to say something about kind of where that leaves us in general, I suppose.
No, it's just very interesting because everyone to a certain degree can agree on what would happen in either outcome. So the way that you just described it, basically, it would be super bearish for a while, even though the sort of volume of oil hitting the market would be pretty much the same. It's just that the certainty on this thing is impossible. Right? It feels like, I don't know about you guys, but it feels like it's just nothing to even write about or to say. It's just like one little twist after the other. It's super hard to understand the negotiations that are going on. It's very difficult to understand US intentions. And so we're kind of left just spinning on our chairs, as it seems to have been all year. Yeah, so I guess that was one of the reasons I wanted to kind of pick up on just very quickly on Brent spread. So one of the things that let's say, surprised me about the last week or two was that we had a 70 cents backward prompt Brent spread. I know the prompt gets a bit difficult sometimes, particularly you get maybe a bit more influence from physical, and we're about to expire. But it kind of surprised me that it was so strong, because the background, of course, is that if we take out the sanctions headlines, the background is that we should be having all this oil, right? There should be this big glut. And yet we're still 70 cents backward. There's talk about overhangs in the Middle Eastern spot crude market. I don't think I fully understood it. And one of the things that I think we discussed internally was maybe combined with a bit of speculation, the end of the year was just a bit tighter than people expected on the spot crude market. So the idea would be that, I was sort of looking through the headlines on Indian imports of Russian being super high in November, but then actually pretty low for December arrival. And so it looks like there was, at least for a short time, a fair amount of switching that maybe I, for one, underestimated. And then you combine that with, China not being able to import Iranian, and maybe there's just a bit more buildup of sanctioned barrels this month than there was on the legitimate crude market. And that is kind of what's also driving Brent spreads. But then the question just becomes, is 70 cents really justified? And I don't think it is, but I guess one thing to add on top of that would be a lot of perceptions can be different post-Christmas, right? So I think a lot of stuff was driven by speculation and fear, also in the diesel market, James, which you can go on to talk about. But one of the perceptions will also change. And things like China finally getting its crude import quotas does help there, because then they can start to clear the Iranian stuff. Maybe that puts a bit more pressure on the spot crude market. Indian situation will be probably different in January. I think we all are still of the opinion that Russian barrels will flow almost regardless of what happens to the peace deal, because there's just more and more stories coming out about Indian banks looking into, financing the Russian flow. And I think possibly we hit the peak level of fear around various markets, and January can still be quite a different picture. Maybe that explains where all the oil has gone. And because as far as I know, nothing has changed about the sort of headline balances being super, super long, Q4, Q1, Q2.
Yeah, I think, I agree. I think maybe I'm slightly skipping ahead, but if we're looking at gasoline in particular, the situation is similar, right? It's not necessarily sanctions led or geopolitics, but yeah, I think I would also say we're probably past peak tightness now.
All right, so let's dig into that then. So why don't we carry on with the light ends? It's fair to say that we've also been a bit perplexed by the strength of light ends for many, many weeks. Or not perplexed, but unsure what to write about it. Is that a fair thing to say? And what's happening now?
Yeah, I suppose it took me, a little bit by surprise exactly how tight, especially ARA did get on the back of what was essentially just kind of planned maintenance, really, or should have been planned maintenance. There wasn't too much in terms of unexpected outages on top of what was expected. Maybe it went on a bit longer than expected, and that's probably the case for Antwerp and for Pernis potentially as well at the moment. That being said, we've gotten from a situation where barge diffs were in the 80s, they're now down into about the plus 15 kind of territory. So supply in and around Northwest Europe seems to have picked up, seems to have responded to that very tight market. Supply has been components redirected into ARA, and so those components markets have started to come off again a little bit. Export demand has shrunk on the back of a very weak TA arb. East-West is still nowhere near levels that are really going to make anything attractive going east either. And TC2 is very strong. Now, TC2 is very strong arguably because of that strong kind of pull on European gasoline barrels going to WAF. We saw that in the kind of the discrepancy between the physical markers for ARA to WAF versus ARA to Northwest to New York, which have been trading at some of their widest levels, kind of in favor of WAF, pointing really to that's where the demand was. But I still think, even with the market having come off over the last week or two, we're a long way from normal yet, especially for this time of year. So December.
So how do you kind of measure that? Yeah, how do you measure the fact that it's not normal? What's the basic indicator?
Yeah, I mean, if we're looking at those seasonal charts that we have, December EBOB cracks are about plus 15 right now, which, even when you had very, very strong markets, 2022, 2023, this time of year, you were looking at maybe plus 9 as a max. So it's just completely outside of the range on the cracks. Deck Jan spreads are at plus 18. Actually, they've been moving even higher again today. So it's just, we seem to be in this very strong market, or the market is pricing to try and incentivize every barrel it can right now. And sure, component markets are relatively well supported, but they're not that well supported. So there seems to be still a little bit of a disconnect there. I mean, I suppose on that, we would have said earlier this year, kind of spreads and gas nap, they were trading at levels that were a bit disconnected from those component diffs. And the component diffs in Europe and in Singapore recently have been catching up to that paper market. And a notable exception there, something that is I still think worth pointing out, is that actually in the US, in the Gulf Coast, component diffs really aren't fantastic. They're the physical market in the US isn't super strong, right? Inventories in Pad 3 are relatively tight. They're certainly not very, very long. But despite that, with the exception of MTBE, really, the component markets in the Gulf Coast isn't very strong. And that strength in MTBE kind of points to the fact that it's export demand out the Gulf Coast that has been really helping to support rather than any kind of pipeline or blending demand domestically.
Is that because MTB is just not in the US blend? Is that, if I recall that from many years ago?
Exactly, yeah. So there's no MTB in US domestic grades. MTB is purely for the stuff that goes into Mexico or goes into LATAM. Just rounding up kind of quickly, looking at what's interesting at the moment in gasoline, there is a lot of strength coming back into the market in the east of Suez, so in Singapore. We've got this kind of slight almost normalization that I was talking about in Europe, and the US is looking a little bit weaker than that. But actually in Singapore, we've got Dec Jan spreads that have gone from kind of +1 to +175 this week. In East-West, that has narrowed quite significantly as well. It's a little bit more difficult for me sitting here in Europe to really pinpoint what's driving that, but we have seen Pertamina coming out and buying relatively strongly. We've got Nayara apparently having issues exporting, and a lot of that Indian, obviously, gasoline does go east, or at least would help to tighten that market there. And we had kind of stock draws in Singapore week on week, a couple of refinery upsets. But overall, it's been difficult to really justify why Singapore needs to price up as significantly as it has been over the last week. The news of Chinese crude import quotas, as you mentioned, coming back for being announced for early next year, should, I think, all else being equal, be a relative dampener on product markets. If we expect that this might turn into Chinese product exports again, but I suppose there's another step to go in terms of waiting for those Q1 or the first lot of 2026 export quotas before we can really say anything on that definitively.
Yeah, I mean, James, I think you've written about, like, there were sort of rumours that December exports out of China, was that just diesel only, or was that all products? There were sort of rumours that it was going to be a bit higher, and I was surprised by it because the whole story up until now has been they lack the export quotas.
Selfishly, I'd only really listened to the rumours about diesel, and there was expected to be increased diesel exports from China in December. I guess that should also factor into higher product exports in general, but I must admit I don't know the answer to that.
Yeah, the last I remember was that they did convert some of their fuel oil export quotas into clean products, but I mean, the way that distillate cracks have been over the last few weeks, I suppose I imagine the margins were better on exporting diesel than they were gasoline anyway.
Yeah, I mean, we talk about this quite a lot. Basically, China's the last barrel that could come into the market, but it's just about, I guess, priorities. What are their priorities? And I think we are not that well set up to understand it, because the incentives must be there, right? The export econs must be very high.
Yeah, I think final one from me, because obviously Rachel always likes to have us put our neck out and have a trade call as well. So on gasoline, I think for context, ever since about July or August, the front month gasoline cracks and spreads have really rallied through the month, every month for the last few months. So when we're looking at that, kind of looking ahead now to Jan-Feb spreads, as we're almost in December, they're currently in backwardation. They've rallied a bit even further today. They're at plus 450 or something for Jan-Feb. And it's pretty rare for Jan-Feb gasoline, EVOB spreads, to maintain any kind of backwardation. Normally there's a solid contango in there. And so, yes, we need to start building inventory again. And I suppose when I'm looking forwards, I can think that if we're getting supply finally, hopefully, coming back in Europe, the arb setup and the blend margin setup are very poor at the moment for demand. So kind of the demand on European gasoline, especially in ARA, is not fantastic right now, or shouldn't be fantastic, with the exception potentially of a WAF arb. And the latest on the Dangote RFCC turnaround and the CDU turnaround are that they are considering delaying that back into January, so running through December. It doesn't mean that there's going to be no ARA to WAF, gasoline demand, but it could well be lower than expected then through December. And maybe that all coming together is enough to lengthen that balance just enough, weaken that prompt ARA gasoline market that maybe we do see Jan-Feb touching contango and breaking this kind of cycle of the last few months of just those prompt spreads rallying very consistently.
Okay, sounds good. We can tentatively turn slightly bearish, but it's kind of situational as well. If we get another announcement about Dangote breaking down again, we're sort of tempting to be a bit long again.
Fair.
Okay, sounds good. Let's go to middle distillates. James,
Yeah,
can you give us... Oh, hello, James. Can you give us a bit of an update on how pricing has panned out since the last time you were on the pod? Maybe you want to tell us how your trade calls have done. Have they done well?
Yeah, so when was I last on the pod? Yeah, I think just maybe the day of expiry for November ice gas, or maybe the day before. And we've seen like a lot of volatility in distillate markets, well, in product and crude markets in general, really. But what have been kind of what have kind of been some of the key factors for distillate? So increased attacks on Russian refinery infrastructure, kind of more detail about the ICE Russian molecule ban, perhaps the addition of like bringing forward of the Platts Russian molecule ban. And I think also there have been some period, like particularly when we're talking about November pricing, some real genuine tightness in the market, particularly as it relates to like November pricing, but yeah, low diesel stocks in ARA, PAD1, and the US in general. But actually, since we saw that volatility or the market really move up because of those geopolitical factors I just spoke about, cracks and spreads have really come off over the last week. And as you and Phil were both speaking about, mostly headline driven by the Ukrainian peace deal, essentially. I also think another key factor, probably less important, but a factor nonetheless, is rapidly increasing global refining runs after a period of maintenance. Northwest Europe, the US Gulf, the AG, and to a certain extent East Asia as well, in an environment of particularly strong refining margins currently.
Yeah, that's one of the things that we discussed, right? How much of this is kind of speculative? How much is known? And I know we've got relatively large runs in the US, but the market kind of expects that, right? It's not a surprise to us. And actually, there's been more surprise to the downside in terms of runs than there has been to the upside in the last few weeks. If we think about some extension of maintenance in ARA, Dangote breaking down, Al Zour breaking down, that's stuff that the market hasn't known about beforehand, whereas seasonal rise in runs is known, let's say. So that's the kind of bit that makes me think a lot of it is just speculatively cooling off because of all the fear in terms of the deflation in spreads.
I would mostly agree with that, Neil. I guess when I see the steepness of the slope of US crude intakes increasing over the last couple of weeks, it gives me food for thought. Like the key factor has been headline driven. And as regards the kind of calls that we made in the podcast last time where we were bullish short-term November pricing, but that wasn't very difficult, to be honest, because it was a day before expiry. And as such, it went out at like $27.5 per ton. So not exactly... 50-50. Yeah. And then we kind of like had a bearish medium-term call on like December pricing, and that has come out. But again, a lot of that has kind of been the risk taken off after those kind of geopolitical events as well. But I do think there's been some bearish factors as well. And let's not forget jet. We kind of had a bearish view on jet because of the weakness of Singapore regrade in that period, like 2 weeks ago, and the reopening of arbs into Europe. And again, that has panned out again as well. But mostly jet has just kind of followed global distillate pricing down over that period of time.
Sounds good. And what about, so let's try and move on to kind of next year, right? So if we kind of make the assumption that there isn't some major escalation in Ukraine, major escalation in Venezuela, ports don't get blown up.
It's a big call.
Sanctions don't get enforced. All this kind of, let's just caveat all this and say none of that's going to be a problem, as it seems to be not going to be a problem just now. What do we think about the status of arbs and how that impacts, let's say, the Q1 diesel market? Like, where are we heading now that spreads have collapsed down to something slightly more normal?
Yeah. Okay. Let's Q1. So let's kind of medium term. Let's not talk about December. Let's talk about like Jan, Feb. Okay. So we've got diesel arbs, as it were, marginally or quite closed into Europe at the moment, probably between $5 and $10 per ton closed. Maybe somewhat workable for refiners, but generally closed. And why is that? Well, we've seen the HOGO really tick up over the last few days, and that really kind of speaks to reasonably historically low or very historically low PAD 1 and PAD 2 diesel stocks currently, combined with a bout of cold weather that we've had across actually the whole Atlantic basin, really. You can feel it here in Europe as well, but particularly in the US Midwest as well. But we do have a situation where we've got, as we just spoke about, rapidly increasing US Gulf crude runs as well, and increasing diesel yields as well. And the US Gulf diff is particularly wide currently. So they want to export. Where to is the question. So generally a little bit closed into kind of Q1 arrival, as it were. We've got kind of Middle East diesel arbs, actually, that have just about turned west again at parity kind of for Indian exports. And actually, Europe is kind of pricing just over the East for Middle East or AG exports as well. We've had, facilitating that, we've had the Gasol East-West move over periods of last week to its seasonally widest for at least 9 years. And even now it sits at its seasonally widest for the last 9 years, if you discount the Ukraine-affected year of 2022. We've got increasing chatter, and we just kind of spoke about increased Chinese diesel exports in December as well, which is weighing on the east kind of side of that equation, which is also helping to send these exports west again. We've seen North Asian diesel arbs more workable into Singapore as well, as we started to see refining runs there improve as well, reflected in the declines we've seen in their FOB Premier as well. And I guess also kind of that adding to that Middle Eastern arbs pointing west story as well, is that we've seen them actually open and workable into New York as well. Again, speaking to those kind of low diesel stocks that we're talking about in the US as well. I also kind of always just don't want to really forget jet as well, but we kind of spoke about it a bit already, but we've seen real volatility in Singapore regrade as well. So we've seen it come off probably the beginning of the month, but now over the last 2 weeks, we've seen it rise from like minus 0.9 to plus 0.7 as well. So like almost a $2 per barrel flip over like the last fortnight as well. And again, this is marginally closed jet arbs from pretty much all Asian origins into Europe as well, which should give some uplift to European diesel diffs, I guess, at least. But they are pointing west again, these jet arbs. So I don't think there's much more uplift to give in European jet pricing.
So that kind of leaves us in where does that leave us? Right? So I'm kind of hearing that the US arbs are closed into Europe. The sort of AG arbs are marginal. The jet arbs are marginal or pointing east, or they were. Is that fair value? Where do we think that kind of leaves us?
When you kind of ask me to summarize the arbs, I always kind of jump into the trade calls. But yeah, I guess to summarize, I guess the most important thing is that everything just feels so headline driven at the moment. So the most important thing, I guess, is to monitor that. How is Ukraine peace deal actually going to filter out releasing of sanctions, etc.? But arb-wise, okay, we've got arbs closed for January, February arrival into Europe from the US in a period where we should expect kind of peak demand in both the US and the EU. So I guess the general feel is that we're not building enough stocks before we get to that period. I guess I'm in the medium term, Q1, I'm generally quite bullish from here. And jet, again, is kind of historically or very, very high regrade values, has closed jet arbs into Europe. So I guess I'm moderately bullish the Northwest European regrades from here as well. If we kind of move then also talk about East Asian jet, then we've got seasonally increasing heating kerosene demand as we move towards January and Feb as well. So I guess I'm also bullish kind of Singapore regrades as well. Was that a good summary? Does that work?
That was good. I think I agree. And I think it sounds like you're also even got sort of a counterintuitive call in the sense that even though the East-West is super wide already, it might need to get worse. Is that fair?
That's a very, very good question, actually. I guess I am bearish the East-West, as it were, because I think Europe, because I guess Europe is going to have to price up to these barrels he's not getting from the US to get it from Asia. So yes, I guess that speaks to the bullish ice gas oil call and then bearish call on the East-West. Yes, yeah, I think that's true.
All right then, there we go. Fairly profound. You got something, Phil?
No, I was just going to say, I like in the notes, I can see James has finished his section with thanks. Very, very definitive.
Thanks to myself.
Yeah, indeed.
Thanks.
Yeah.
Thanks
Neil,
to me.
what have you got to say on Crude, mate?
Well,
but
we
no,
are
really, what
all
do you
very
have to say
thankful that you turn up to these things,
Crude?
James. Yeah, shall we move into Crude? Yeah, I'll go on Crude. So I'm also a bit confused. Apart from the kind of Brent spread argument, which we went over at the start, I think Brent spreads may well cool off. Obviously, it's also very headline dependent. And it also makes me less sure about what I should say about the physical market. There's a couple of things I think I could say. One is that physical premiums, generally speaking, remain weaker than we have seen for much of the year in many markets. So I'm talking about WAF, I'm talking about, to a certain degree, the North Sea, I'm definitely talking about the AG. And now we have, I think, over the last couple of weeks, hit this somewhat cyclical spiral downwards, right? So we saw a week or two ago that Brent got super weak, and my assumption was that this is because there's plenty of supply in the West and the arbs suddenly closed up, and the arbs were a key kind of outlet for the West over Q3 that was definitely needed.
Yeah.
And now that's kind of corrected a little bit, possibly. So Brent kind of looks overly strong now, even though it's actually not that strong. But from our perspective, it's kind of too strong. The AG looks kind of neutral. I think there's a bit more interest in spot AG markets. So, potentially speaking, the AG might even have a relatively short-term bullish stint for the next week or two, just on the arbs and just what's happening in terms of India and China, basically. But overall, it seems to be that we're still hovering around this relatively weaker place for physical crude. And the main conundrum that we had, and I'm very, very happy to say I've been wrong, at least timing-wise, not logic-wise, for at least a month. So I really thought that TI would be building, US crude stocks would be building more over the last month. Possibly the timing was just wrong in the sense that TI was actually pretty cheap globally in terms of arbs over September and much of October. So one mistake I was making was just to think about timing a bit more in terms of when that will turn up in the EIA data, for example.
That was actually then November loaded, I suppose.
Yeah, well, yeah, exactly. It was sort of end October, start of November. Maybe it shouldn't have been a surprise that TI exports were relatively strong for a bit. Plus, there's all the kind of uneconomic stuff, let's say. I'm saying uneconomic in that India was kind of forced to buy WTI in a way. There's talk of all these deals being done in Vietnam, Pakistan. Yeah. So maybe I should have seen that coming. I just didn't see it. But at least, basis last night's data, the exports do seem to be coming off a lot, and it seems to be getting confirmed by cargo tracking data as well. And the result is the 4-week average commercial crude build in the US is actually starting to look quite weak now, as in large builds.
Yeah.
So I'm relatively more happy with that. It starts to make a bit more sense to me. Maybe this is the start of something in terms of now we start to get more OECD crude building up instead of sanctioned crude.
Okay.
So if that's true, then we might be in for more weakness. All else equal, ex headlines.
Were we potentially guilty of underestimating the impact of lower imports into the US as well? It's not really something that we often look at in terms of econs into the Gulf Coast or stuff from Canada.
I would say that I was surprised by the level of US imports and the level of imports, seaborne imports into PAD 3. One thing that is definitely happening is there is simply more Gulf of Mexico or Gulf of America supply, which is sour supply, getting into the US system without being classed as an import, let's say. So there's naturally more supply probably being used in Gulf Coast refineries. There's obviously less supply reaching PAD 3 from TMX, which kind of is going to show up in the data too, but needs to be counterbalanced. I have made a bit of a story about the net trade data from the US. I'm not sure I can fully explain every barrel, but it possibly does make some sense when you think about sort of Gulf of America supply, Gulf of Mexico supply. But the main thing is that exports were too high for me. So it's I'm pleased that the exports finally start to come off. And that makes more sense with the ARB pricing we saw for TI. And It actually helps the story of where the hell is this glut, this oil glut? Why can't we see it by now? So hopefully it continues to go my way, even though it's probably early days. We might need 1 or 2 or 3 more weeks of the same signal before the market gets it.
Right, gotcha. Okay, thank you.
Do we want to go into a quick fire round?
Yes.
Let's wrap it up quickly, I suppose.
Why don't we start with Phil, then let's go with naphtha.
Sure. So naphtha, I suppose the headline on naphtha is that we've got the East-West doing, I suppose, the opposite of what we're seeing in diesel. It's up into the plus 40s prompt. It's really at crazy levels, and it's pulling the margins on the arbs into also pretty almost record territory as well. So there's a few bearish factors for European naphtha. It's just seasonally, it's not a great time of the year for the European naphtha market. And for whatever reason, the East has managed the physical prices and the paper prices in the East are remaining pretty robust, despite that open arb for a while now. So, there's no end in sight for it. We can see, at least not in the short term, and just a lot of money to be made putting LRs together and moving that naphtha to the east.
Some stage that's going to be a rug pull, but we don't know about the timing there. I'll do the one fuel oil one. One fuel oil is just the Sing 380 crack, so there was a bit of a move up on Monday, but generally speaking, we see very weak cracks, and 380 spreads are also pretty weak. There was talk about kind of Reliance taking a bit more Iraqi HSSR. That's one of the key questions going forward, right? Do they replace the sort of Russian stuff that they were taking. Maybe Reliance will, but India, generally speaking, still kind of an unknown. And generally speaking, the fuel oil market remains pretty weak. And it's one of the things that I've been contemplating over the last week is actually it's becoming fuel oil of low and high sulfur is becoming a bit of a drag on simple margins. So if you look at kind of Bonnie light simple margins in Europe or delivered light sweet margins into Asia, these things are approaching the zero line or even negative. And the question becomes, can the clean products really afford for that to happen? Because that also represents the last percentage point of utilization in the global system. If those start to get affected, then that's bad for the clean balance. And if we're really super tight, then we don't want that to happen. Or fuel oil works its way into refining and it's bearish for crude because that's also one of the mechanisms, apart from things like power gen.
Right.
So that's one of the things we have in mind.
Good stuff.
All right. And that's a wrap for this week's episode. Big thank you to our listeners as always. And if you agree, disagree, or just have something to point out, send it our way. We'll have a good debate. And we will catch you next week as usual, where we will have new headlines, I'm sure, new analysis. And as always, we hope you trade with conviction. Thanks very much.